Now let's look at Canadian departure tax and then deemed disposition. So what happens on the US side is that, on the Canadian side, I'm sorry, on the Canadian side is that when you do become a non-resident, CRA will tax you on certain assets, even though you have not sold, right? So what it is that we call that a deemed disposition. So it's not actually selling, nothing has been realized or actualized, but it's happening on paper. So a deemed disposition is a tax event where an asset is sold at its fair market value, even though no actual sales has occurred. Deemed disposition calculates a capital gain on assets by calculating the difference between the fair market value and the cost. The capital gain generated through the deemed disposition is taxed by the CRA, which is known as the departure tax. This is what the deemed disposition is. So when you do leave Canada, there are certain assets that get deemed dispositioned, and then where the capital gains is triggered, and then there's tax on it. In some cases, there might be a loss. Of course, when there's a loss, the government doesn't want anything to do with it. When there's a gain, they want the tax. So deemed disposition is a paper realization. It's not an actual sale of assets, right? So this is what the deemed disposition is. And then so there are certain assets that where we have deemed disposition on the Canadian side.